perfect. Thank you so much. Again, let me actually skip most of my introduction in the interest of time because we are starting with some delay. And Deniz needs to take a taxi at 1:30, so we should be punctual in finishing the panel as scheduled. So as I was starting to say before, it's an honor to have this distinguished panel here today, talking about housing risk. If you check their websites, they share this very strong research profile with publications in leading journals with a very ample research experience in policymaking institutions. So I had some remarks on bios of each of you, but I will skip that. So the speakers on my right-hand side had Intertwin, International Monetary Fund, Bank for International Settlement affiliations during their careers. Caterina on my left-hand side is been moving around central banks in the world, including Bank of Canada, Banco de Portugal, and the ECB. And I think they are going to offer us initially some different perspectives based on their research and policy experiences, and I'm really looking forward to seeing which topics come out in the introductory remarks, and then open a discussion between the panelists and also with the audience, so your questions will be welcome in the second or third stage of this session. So without further ado, we will start with Deniz, continue with Gaston, and then with Caterina, because this was apparently the most reasonable way of connecting the initial remarks. And the floor is yours, and this is the pointer.
Thank you very much. It's really a great pleasure to be here today, and sorry for putting the time constraint on everyone. Thank you to the organizers for including me in this, and also for putting together a very impressive program. It has been really very nice papers, very good discussions the past day and a half. So I will first briefly remind all of us why housing is a special sector. It's different from others. And then I will review the risks in the current junction. What are the risks in housing markets with a global look? I'm not going to talk about specific countries. And then I will wrap it up with some issues maybe we need to pay more attention to collectively. And before I move on, the usual disclaimer applies. These are my views, not the IMF's. So housing markets have a crucial role in the overall economy. Starting with the production side, they are closely linked to pretty much every other sector of the economy. They have strong spillovers. There is, of course, the direct value added from construction when we think about housing, but activity in housing is also linked to other sectors. Real estate services is one. You need an agent in most countries to sell or buy a house. You need the mortgage services in order to finance, but you also need to furnish that house. You need to do renovations, whatever it is. It's really is a, in that sense, upstream kind of sector. But it's also linked to the government sector. Land sales, property taxes in many countries is a major source of revenue for local governments, sometimes federal governments as well, general governments. And this creates very complex dynamics in terms of government finances and housing market activity, and of course the economy at the end of the day. But beyond this business cycle frequency, housing can influence allocation of resources as well, and that has implications for productivity growth, that has implications for potential growth. Why? Well, construction sector, starting from there, is labor intensive, and it has been shown that it also has low growth productivity, but productivity growth potential. So what happens is that when construction grows disproportionately faster than the rest of the economy, it typically signals misallocation of resources, and that can be long-lasting in terms of its implications. Then there's the special allocation question, right? And we have cities, and agglomeration is typically good. It's, like-minded people, certain sectors come together. There are more exchange of ideas, you have more innovation, right? But this type of agglomeration can also have risks, especially in countries where we have very rapid urbanization processes. You can have overcrowding, you can have infrastructure failures. And why do these all matter? Inadequate living conditions have also implications both for households, and you can take it from well-being perspective, and we have seen that during the pandemic. It's not only living conditions that matter for individual households, but also they matter for society. So that then brings me to lack of affordable housing and the social value of housing. In many countries, housing is actually seen as access to adequate housing is seen as a human right, and there are expectations for governments to play a role in making sure that there's access to affordable and housing that meets certain standards. What then does is raises a major motivation for policy intervention, and it also raises very crucial political economy questions that I'm going to come back a bit later. Now, turning to more the financial side, given that we're in a financial stability conference. Housing markets are prone to risks, and they have significant implications for financial stability. Why is that? For one, housing is not small potatoes. It's actually one of the largest items in household balance sheets. On average, about 50% of total assets in household balance sheets is housing related, right? And you take it from there, and then it's used as collateral. You can see how big its importance is in the financial sector, just from playing that role. And then what's also important is that pretty much all agents that are involved in the housing decisions, consumption and investment and financing, they are leveraged. Households are leveraged. When you take a mortgage, we're talking about LTV ratios typically between 50 up to 90%, and you cannot have that with any other asset class. You cannot go and tell a bank, okay, I think Apple stock is going to really do well. Why don't you give me a loan with that type of numbers? They will not. But they routinely do that for housing purchase. But the agents involved on the other side, the lenders, are typically banks, which we know are leveraged themselves. So that opens the door, that leverage component opens the door for financial crisis. And to add more to the complexity, the whole financial linkages, is that housing has significant frictions and substantial network externalities. Just to make it very simple example, you cannot sell one room of your house, right? It comes as a whole. So you can sell part of your portfolio, but you cannot sell part of your house. So that lumpiness creates effects, neighborhood effects are all there. And in addition to that, housing is actually very opaque. Information is not easy to come by. Comparison of different properties can be very difficult. All these information frictions then have implications from a financial sector perspective. And it's macroprudential policies that are designed to mitigate, especially this last part, what I have as the last two bullet points there. That's typically the focus, but the implication is generally for the macro economy. Now, with that background in mind, let's look where we are today. Now, during and after the pandemic, house prices actually rose very strongly. And this was especially the case, what you see as the red line there, especially the case for advanced economies. And importantly, this breaks the typical post-recession recoveries in housing markets, right? Typically housing lags, and it has a big correction that coincides with a recession and is slow to recover. We saw quite the opposite dynamics this time around. And what are the reasons for that? Well, we had the shift, the need for space that was related to the pandemic, and also the increased demand from investors in a high environment, but also at least at the beginning of the pandemic, very generous financing conditions as well. But the supply side also mattered. You may remember that we had the spikes in lumber prices, in steel prices that was related to supply chain disruptions, but also the lockdowns. So construction activity was actually quite affected. So you had this clash of increased demand and constrained supply on top of what's already a very sluggish supply response because of zoning regulations, building restrictions, and whatnot. So it's the perfect storm that created the push on prices. But then what we had, of course, is the tightening of monetary policy across the globe, and we saw the house prices stall. In some cases, we saw some corrections. You see it in again, especially for the advanced economies. What is interesting, though, is that the correction at the end was quite short-lived. In many advanced economies, we are seeing house prices, real house prices, rising again. And that's a little bit of a surprise. And one question you might ask, is this the type of thing that preceded the global financial crisis? Are we in for a repeat? What is the overvaluation and potential for a correction? What I would say is that the answer is a guarded no. And the major reasons for that is, compared to what happened in the early 2000s, the rise in house prices is not necessarily driven by credit growth in many economies. So we don't have this twin boom of credit going up, mortgage credit in particular, but also house prices going up. And it's typically the combination of the two that creates the problem. And there is no more benign neglect. You'll remember that asset prices were left to their own, but now we have a macroprudential mindset, and the new policy frameworks we have on the macroprudential front, tighter credit standards that we have, greater buffers in the system that we have, they're all comfort points. That said, some countries are, of course, more vulnerable than others, and especially to watch is that institutional investors and NBFIs, non-bank financial intermediaries, are becoming bigger players in some cases. But aside from the financial stability, I'm going to argue there's a bigger problem, an imminent problem that's pretty much everywhere that we're seeing globally, and that's housing affordability. So for much of the post-GFC recovery, we actually have seen housing affordability improving. Why? Because house prices were correcting, right, in many cases, but also interest rates were very low. So the index we're showing here is a very simple one. It's basically trying to capture what is the ratio of typical household income to the income that would be needed for that household to qualify for the mortgage to buy the median-priced home in their country. It's simple, driven by income developments as well as interest rate and house prices, of course, but it still gives you a nice picture and captures the main idea, which is the mortgage finance home ownership. That's the main affordability, the metric in many countries. And the pattern that we had seen in terms of the climb in house prices, that continued, and we had seen affordability still being, quite well, because yes, house prices increased during the pandemic, but so did disposable household income, right? It was actually very surprising how fast it recovered, how strongly it recovered. So it was kind of holding affordability at a reasonable range. But then, of course, came the tightening of monetary policy, pass-through to mortgage rates, and if we hold everything else constant and consider very generous mortgage terms, fixed rate, very long term, and reasonable down payment, not much, but a doubling of interest rates would still mean that the typical household, average household, has to pay 40% more on their mortgage today, just because of the doubling of interest rates. And in some cases, things are even more complicated because you have this, adjustable rate mortgages, and that squeezes current owners with immediate resets, but also potential to be buyers cannot come into the market. And it was shown in one of the presentations, actually, in this adjustable rate mortgages, some of them have not reset yet, right? So we might still have some in the pipeline of this squeeze that's going to be felt by some households. In other cases, we have seen a shift away from adjustable rate mortgages and to fixed rate mortgages, of course, with the low interest rate environment. But now it created a lock-in effect. And this is discussed a lot in the US context, but it's also visible in many other countries. What that is doing is that the households that bought during the pandemic or they refinanced during the pandemic to fixed rate mortgages at 2-3%, they're not moving. They're not selling their homes, right? Even if they may have a reason to, because they cannot then go buy a house at a higher price, but also at 6-7% mortgage rates. And that squeezes supply a lot. It creates mobility problems, right? We talked about misallocation a little bit. It puts a floor on house prices for newcomers. It's much more difficult for them to enter the market. And current homeowners without a mortgage may capitalize on the higher house valuations, but then it can create intergenerational inequity, right? Because these tend to be mostly retirees, older people who have been in the same house for 20, 30 years. Now, this dynamic of winners and losers, of course, happens within the same country, but it can also happen across borders. What we're kind of calling the transnational class of super rich, and most of our real estate investing purposes can come in with cash purchase offers, and that squeezes the local population from getting into the market. And again, so just to give you another statistic, more than a third of poor households, so the lower quantile of the income distribution, are actually overburdened by housing costs, meaning they spend more than 40% of their monthly income on housing, either rent or mortgage payments. And what that does is actually housing, affordability of housing, is a #1 issue in many opinion surveys, ahead of healthcare, ahead of education. So that gets into the radar of governments and policy makers and politicians, of course. And governments are pressed to find solutions to make housing more affordable, but doing so directly may not be practical, right? It means fiscal outlays. It may not be efficient because you need to come up with, allocation and whatnot. Government is not the best one to provide those, maybe. Policy tools like, zoning restrictions, maybe loosening those, but that can be difficult because sometimes it's not the central government that has the right to do that. You have the local governments, the whole local politics coming in, right? And this can be the supply side solutions can be quite difficult, in other words. Then pressed with the demand from the public to do something, demand side solutions come into the picture again. And this typically means debt financed more home ownership that's subsidized by taxpayers in different forms, but it's actually quite common. So I talked about supply a lot, right? So we have done some research. Is it just our impression? We're hearing more and more, supply is so restrained, this, that. So we have done an exercise across countries and going back to the 70s. And I'm not going to get into the details. This is a BIS quarterly review special feature, and that came out in December last year. So the price elasticity of housing supply has actually fallen. In the 70s, 1% increase in house prices would lead to, on average, an increase in building firms of about 6%. And by the 2000s, the elasticity fell down to 4%, right? And the decline is attributed to tightening in land use regulation, but also lower productivity growth in construction sector. It's just, again, food for thought. The supply elasticity, as you can see in the middle, across countries, there's a lot of variation. You might think, well, that has to do with geographical constraints, but let me just get your attention to two country cases, Switzerland and Austria, which are both, countries, beautiful countries with a lot of mountains, so difficult to build and whatnot, but they have very different supply elasticities. So there's something more than just the geographical constraints there. And what you might think then is that the more elastic the housing supply, the smaller the change in house prices for a given change in demand. And that's actually what we're finding in the last graph there. We find that house prices tend to be less volatile when, in countries where there's more elastic supply of housing. The flat line that you see there is for rents. And that's also interesting, especially for monetary policy. Right? It's basically telling you that house prices would react if there's enough elasticity, but rents do not seem to care whether there's supply elasticity or not. And that matters for monetary policy, but also for macroprudential policy. So I'm just going to finish it by basically a call that collectively we need to pay much more attention to the supply side of housing. In many of our models, we kind of ignore it. We say it's fixed, at least in the short run, and don't think about it, but maybe it's time that we need to. Let me stop here. Thank you.
Thank you very much, Deniz. Your thoughts on the supply matters is very thought-provoking and punctual for the situation in Spain, where we feel that there is a clear lack of supply in the current environment. I will wonder later in the discussion to which extent this is an issue for macroprudential policy to directly care or take as an element of the environment in which we have to unfold our macroprudential policies. But it will be interesting to see whether the scope of macropru should go also into making recommendations for the supply of housing. Gaston is next.
Thank you.
I'm going to change the slides.
All right, thank you. Does it work? Yeah. Thank you for the opportunity to be here at this fantastic conference, in this fantastic setting. And I've been really enjoying the different papers and discussions so far. So also in my case, the institutional disclaimer applies. I want to talk a little bit about the cross-country evidence and some research related to the effectiveness of macroprudential policies for real estate in particular and related challenges. So if you look at the number of the diversity of tools in the macroprudential spheres that are being used, it's quite large. So this is already a little older. I hear it's now over 2,500 different measures that are being used, but it gives you a sense. What I would like to highlight is that those in this classification that I'm showing you here, the household sector related measures are pretty significant. So, and these are mostly related to housing. And this is from a study that the CGFS did about 1.5 years ago. They covered the case studies with a number of 14 countries. That's why this table here shows the sample. But it's just to illustrate a little bit what the combinations are typically of these tools. I mean, broadly speaking, in the sphere of housing, you have on the one hand the borrower-based tools like loan-to-value ratios, debt service-to-income ratios, debt-to-income ratios, and then those that are more focused on the lender side, on the banks, like capital requirement, risk weight requirement, and so forth. One should also keep in mind that supervision typically plays an important role. So I'm not going to cover that, but in the context of housing risk supervision is active typically and plays an important role. In terms of macroprudential tools, the loan-to-value ratios, LTVs, are the most common tool. there are only two, as far as I know, two income-based tools, the DSTI and the DTI. And other tools are used more rarely, for example, leverage limits on real estate funds or sectoral systemic risk buffer limits. They are used more rarely in the context of real estate and housing. So what have we learned over the last 10 years or so? Well, there is by now pretty strong evidence that these tools tend to work very well. So one problem, obviously, when trying to assess the effectiveness of these tools is that there is an endogeneity problem. Now, these tools are put in place in response to certain dynamics, so it's sometimes hard to disentangle cause and effect. And so recent studies have tackled that endogeneity problem through various ways, sometimes using microdata, sometimes using policy surprises or other econometric techniques to deal with this issue. And these studies, they do find relatively large and highly significant effects, particularly for borrower-based tools. And more generally, there is evidence that macroprudential policy, including these tools, succeed over time in containing the buildup of vulnerabilities. The strongest evidence or the strongest effects come from LTVs, DSTIs, loan loss provisions, and loan restrictions. This is for credit, for household credit. Overall, the effects on house prices are a little weaker, but they're strongest for the LTV and the loan loss provisions. And capital requirements overall have weaker effects, both on house prices and credit. So this is from a meta-analysis looking at a large number of studies and taking stock of the effects, the average effect weighted by the statistical significance. And here you can see that differentiated by measures that use microdata or macrodata and then combined in red. Blue is microdata, yellow is macrodata. That the housing measures, particularly when you look at the microdata effects, are fairly strong. Now, why these strong effects using microdata? Well, partly it has to do with what I was saying earlier, that you better overcome the endogeneity effect with these macrodata. But perhaps it's also an overstatement because the aggregate effects also take into account or they measure leakages, right, and more general equilibrium effects that you don't see when you just look at microdata. So we know more about the effectiveness, and they seem to be quite effective, but the precise calibration and the quantification of the effects is still work in progress. We have made some more progress for LTVs, where newer data measures not only 0, 1, is this tool in place or not, is it used or not, but the actual size of the LTV. And so we're getting a little closer to an actual quantification that can use for calibration in the context of LTVs, but not yet for most of the other tools. Nevertheless, it's important to try to start to communicate the macroprudential stance within some kind of cost-benefit framework, even if it's imperfect. Some have started to do so, but it's challenging, right? And here, a tool that Javier has been working on quite a bit and has made important contributions, namely using the tool of growth at risk can be useful, that has been starting to be used, but not yet consistently. Let me illustrate a little bit how one can think about it. So this is based on work with former IMF colleagues. So if you look at okay, so this is, okay. This is, I have a dynamic slides, so I cannot show you all the effects here, but the idea is you have a projected distribution of GDP growth X quarters ahead. You can estimate that with quantile regressions. And then suppose you have looser financial conditions, then that that is good in the near term for growth prospects, but then you have an increase in the left tail of the distribution. That is the risk that you get bad outcomes rises over time. Then the question is, can you, with macroprudential measures, adjust that distribution, influence it in such a way that you reduce those higher left tails or larger left tails? And then you can do this, not only for 4 periods ahead, 4 quarters ahead, or 2 quarters ahead. You can do it for a longer time horizon. So you can predict the distribution over say 2 years, and look at and estimate using, again, quantitative regressions, how those distributions change with imposition of macroprudential tools or not, in reaction to some changed environment, for example. Then you have those, okay, well, now you need to compare them somehow. One way to comparing them is to use a quadratic loss function. So you can use a kind of a standard quadratic loss function where you weight the variance of output and variance of inflation. And we did that, and then we found, using data from 34 countries, that over time, indeed, these losses can be reduced substantially. Here, this chart shows you the comparison of financial institution-based macroprudential measures, FI, and broad-based measures. And you see that on the x-axis you have the quarters. On the y-axis you have the change in losses, so lower is better. And you see that these are the cumulative change in losses. And you see that the effects accumulate over time, so that you can improve, at least on this somewhat admittedly ad hoc metric, but widely used metric, the outcomes, the expected outcome. Now, I don't want to oversell this, right? In the sense that there are many problems with these type of estimations. You have to assume many things. As I mentioned, we lack the precise measurements of the tools and so forth and so on. But my point is more than selling you a particular technique. Is more to say that this is an attempt to quantify a little bit the overall effects and looking at the cost benefits overall, and further work in this area is, I think, useful to get to also to something that you can communicate better, right? Financial stability is elusive. You cannot see it, you cannot measure it, but you can say, okay, if we take these measures according to our models, the probability of a sharp recession is reduced by X% over the next year or so. That's something that you can communicate, right? So I think that's something that's useful. Let me say a few brief things about governance before I conclude. So, particularly when it comes to borrower-based measures, and Klaas not alluded to this in his speech yesterday, it becomes political, it's sometimes difficult to act. There's a bit of an action bias. And so what can you do about that in terms of governance? And again, the CGFS did some work on this, and these mandates, these principles that I'm showing here on these slides, they all sound intuitive, but they have also concrete meaning in the sense that it's always useful if you have one institution that's really accountable, that has a clear mandate. It's good if you can pair announcements with the ability to act, right? So here in case of Spain, the Bank of Spain has the authority for banks in terms of a macroprudential policy, for example, of course, if you have this clear legal basis, that helps to mitigate inaction bias, and if you have operational independence. Of course, the capacity, the technical capacity to measure risk is also important, and the capacity to enforce compliance, and ideally a mechanism to kind of look beyond the specific measures in a broader context. That's why you have often these financial stability councils where fiscal measures and others can be coordinated. So, two more thoughts. There are some tools that make it a little bit easier to overcome this inaction bias. For example, those that you don't need to adjust so much with the cycle. So LTVs, they have the drawback that in boom phases, they automatically look better, right? The value of the houses go up, and then they look better. Whereas the DSTI or DTI, debt service to income or debt to income ratios, they don't have that property, at least not so much, because incomes don't move as much as house prices, at least not in the same cyclical way. So those don't need to be adjusted as much, and that could be an advantage. Already talked about quantitative cost-benefit frameworks, but there's of course many more things to talk about, but we'll have some time in the discussion. Thank you.
Thank you very much, Gaston. Your presentation was clearly complementary in the sense that you have referred to tools that have been used in the specific macroprudential setup, and mention issues that I will also like to retake in the discussion regarding how to justify to society the activation of tools that, because of considerations made by Deniz before, could be socially problematic, because some of these tools will have implications for who is able to afford the house under the existing financial conditions. So I think Caterina is going to further elaborate on the affordability conditions and the situation regarding housing risk in the Euro area. Caterina, floor is yours. Yes, and also let's have a pointer. And the change.
Hello, everyone. Do you hear me well? Okay, fantastic. So first, let me start by saying that I'm very happy to be here. It's really an honor to take part to this panel. And in my remarks, I would like to offer a perspective which focuses mostly on the role of borrower resilience for macroprudential policy and the importance of credit market conditions. And as Javier said, I'm going to give a perspective mainly based on Euro area. Maybe it's better like this. I felt it was too strong. Okay, anyway. So in my remarks, I will focus on 4 main points. So the first is that housing risks and borrowing conditions are intertwined, and they are both important to assess borrowers' vulnerabilities and resilience, which, as Gaston was mentioning, is one of the main goals of some borrower-based measures. And although in recent times household vulnerabilities have eased, I would like also to stress that elevated uncertainty could actually weigh on future macroeconomic developments. And in this context, borrower-based measures play a critical role in supporting financial resilience in the Euro area, Nevertheless, trade-offs between monetary and macroprudential policy might be less pronounced during periods of high interest rates, which is something I would stress on a positive, with a positive tone. And so let me start by mentioning that while the ultimate goal of, or the ultimate objective of macroprudential policy aimed at containing housing market risk is financial stability, policymakers usually translate this into more specific intermediate objective. And as Gaston was stressing, borrower resilience is a key target in most countries, including euro area countries. And then there are a few other countries which also seek to dampen the credit cycle or lean against house price exuberance. Now focusing on the euro area, household vulnerabilities have recently eased in recent years. And on the left here, actually there, what you can see is that this was mainly on account of improvement in financing conditions and debt service capacity, and to a lesser extent to leverage. And looking ahead, our composite indicator of household vulnerability suggests that vulnerability in the household sector are actually expected to remain low. And this easing in household vulnerability actually goes hand in hand with the fact that the financial cycle positions are subdued. And for the euro area, this gap last turned positive in 21, but then quickly fell back into negative territory and has not recovered since then. As you can see on the right, this is our measure of systemic risk indicator, which is also an indicator of the position of the financial cycle in the euro area. And what the chart indicates with different colors is that the downturn in financial cycle reflects subdued dynamics in real estate, residential real estate, and in credit growth. But so while the financial cycle is actually expected to recover in this next future, I also want to stress that given the uncertainty triggered by trade tensions and increasing global geopolitical risk, there is still considerable uncertainty about financial developments in the euro area. But let me also stress that even if you just want to have a quick look at the Basel gap, you will still find that most developed countries have a negative gap. This is true in most advanced economies. And before I forget, let me also stress that these are my own views, just in case. Then moving on, so there is a subdued financial cycle, but this is expected to recover based on expectation of the gradual recovery in lending. And when we look at bank loan dynamics, we see that actually lending has finally started to recover gradually in recent quarters. And this is mainly on account of loans for house purchase, depicted in yellow in the left-hand side chart. And so this gradual recovery in bank loans for housing purchases also contributes to a narrowing of the credit gap. And on the right here, I report results from a counterfactual exercise where we compare the gap. We report in the solid line the gap between the realization of loans to households over time and what the model will predict conditional on the actual macroeconomic developments. So the message is that since the onset of the recent hike cycle that is depicted there with on the right chart with the dashed line, household credit growth remains below what you would expect given the macroeconomic conditions. And even even at the end of the period, there is currently a negative gap. Now, just to put things into context, when we look specifically at the household sector, that is the solid line, we see that this gap is quite remarkably smaller compared to the credit gap that you would find looking at other type of credit, like loans to firms, or also credit measures that includes loan to non-bank. So bottom line here is that there is still strong credit growth is still needed to close the existing gap. Now, the current recovery in loans is also associated with an recent increase in demand for housing loans. And this is what you can observe on the left chart, where following the decline in borrowing cost, we see that the demand, especially for mortgage loans, has increased. And these are results from the bank lending survey. And here what is reported is the net percentage, we see that the percentage of banks reporting a strong net increase in household loans keeps gradually going up. And this, if you look at the decomposition, it's obviously related to declining market interest rates, but also housing market prospects and consumer confidence play a supportive role in supporting demand for housing loans. Now, most recent survey, however, point to a decline in household expectations, likely reflecting the current elevated policy and economic uncertainty levels. And this is evident both if we look at the survey's indicators of housing demand, where you see both on real expectation of real estate being a good investment or planned house purchases, you see that it stagnates, or in particular on the right-hand side chart, expectations of access to credit, it's deteriorating. So the credit sentiment is deteriorating, which is also in line with the fact that banks expected the demand for mortgage to grow at the lower rate in Q2. So why I'm telling you this? Just to give an indication that the credit gap, what this evidence suggests is that the credit gap, negative credit gap on household loans in the euro area is still there to persist for a little while, most likely. What survey results can indicate also is the fact that the recent monetary policy tightening actually keeps transmitting. So this here I'm going to show you results from a recent analysis which has been just published as an ECB blog and will also be published as a featured article in the next economic bulletin. And on the left, what I would like you to focus on is on the fact that households in the bottom of their country-specific income distributions are actually those that are more likely to hold mortgages, which are set to reprice by 2030. Now, because of that, the micro-simulations of the evolution of the average rate among different groups of households, which I saw in the middle chart, make it evident that poorer and liquidity-constrained households face on average higher interest rate on mortgages, that is the green and red line here, which are set to keep increasing in the next years, even if one assumes that the rate on new mortgages stabilize. That is what's depicted in the blue line. So overall, these facts suggest that this slow pace of mortgage repricing could also have an impact on consumption. And of course, these are model-based results, but when we ask households, and this is one of the doc questions asked in January 25, if they really care about their interest rate on mortgages, what they report is that households with a variable mortgage rate or fixed rate mortgage which is about to reprice are more likely both to make more advanced repayments on their mortgage to reduce their monthly payment and to plan to reduce consumption in the future, basically corroborating the model results. Now, so in this context, the main priority for macroprudential policy continue to preserve resilience. And in the euro area, borrower-based measures, as most of you know, are mostly taught as structural tools. So this means that different from capital requirements, which have a counter-cyclical component, borrower-based measures are not meant to change over the cycle, even if we observe changes in the credit cycle and in household vulnerability. But they are meant to act as a backstop against excessive indebtedness, reducing tail risk. Perfect. But so we know, however, that the cost of borrower-based measures varies across the cycle, and we think that allowing for a constant bindness is actually key. And this is what we observe many countries doing. So in this table here, I'm reporting the measures, complementing Gaston evidence, I'm reporting the measures recently adopted by banking union countries where they have different limits on LTV, DTI, maturity extension. Obviously, the LTV and DSTI and LSTI are those that are most commonly used. And if you wonder about difference across colors, so the blue is what applies to all borrowers, while the red is what applies to first-time borrowers, and the yellow to the subsequent borrowers. So some countries differentiate on this and others not. And all this to say that in the euro area, there has been a huge effort in implementing borrower-based measures to ensure borrower resilience in the last years. And let me just move directly into my final slide on the relation between borrower-based measures during rising interest rates, which, as I mentioned, during rising interest rates, one might think that trade-offs between the two types of policy are more limited. And what we show here, these are results from a recent paper co-authored with Luis Herrera, which is actually here, and who recently joined the Banco de España, and who can answer questions on this slide. I'm joking. And but here I'm just showing a very just partial view of our results. And we have two panels, and consumption and bank net worth, and we look at the impact of rising interest rates, both on consumption and bank net worth, that is depicted by the solid line. And then we run some counterfactual experiment. And the interesting one is depicted by the dashed blue line, where we show that changing the LTV to maintaining the bindiness of the LTV constant over time, it's actually beneficial both for borrowers and doesn't harm banks. So this shows that despite being an instrument targeting borrower resilience, it is important to fine-tune it to ensure to prevent excessive tightness of these measures during periods in which lending standards are already tight for households. And then just as a final remark, we then compare with other type of policies, which instead depend on the cycle, like CCYB release. And here we say that this can also be beneficial. However, it is beneficial provided that the banking system remains overall well capitalized and resilient, not unconditionally. And with this, I conclude.
Thank you very much, Caterina. Very interesting to see your complementary remarks on the situation in Europe more recently, and also something that I was going to ask Gaston, because in his methodologies, I think it was clear guidance based, for instance, on growth at risk and possibly some complementary indicators on when is the right moment to activate macroprudential policies for housing risk. But I was going to ask, but how about the calibration of the tools? And I think that Caterina points to quantitative models being a potential approach to the calibration and also to the time management of the tools. You need, in a sense, to be able to run the counterfactual of how, if at different points in time you consider relaxing the constraints imposed by borrower-based measures, what would be the implication. And also, I think this is a field where all our sort of different expertises and methodologies converge. No? We need the microdata to calibrate the cross-sectional impact of the tools. We need the more macro aggregate econometrics to be able to say something about the big picture implications in terms of also of, I buy very much the idea of communication accountability are key in a field that is potentially socially so problematic. So even the independent authority in charge of managing borrower-based tools might find political challenges to activating measures that could damage particular groups of the population, especially the young or the forming families when buying a first home. So now we have limited time, so I'm going to allow each of you to potentially react to the overall discussion or to some questions that I will drop. Feel free to choose your favorite. So out of Deniz's intervention, I was wondering whether there is a macroprudential angle to intervening on who should own domestic housing units. So will there be a macroprudential angle to saying it is not a good development that non-residents, you were referring to the super rich, buy part of the housing units? Is there a financial stability angle? But if there is, there could be also an angle to controlling an excessive tourist-oriented model of growth. Like in Spain, I think when we estimate demand for housing, we should incorporate the demand for residential solutions for tourists that visit us in millions in a year, how they compete for space with also families that are formed, immigrants that are flowing in. That I found fascinating from your presentation, also talking about the rigidity in the supply. I mean, maybe we should take it as a given, but as analysts, we should seriously wonder what is behind the increase, the reduction in the elasticity to the price of housing supplies. I was wondering whether in the Spanish context, and maybe in some other context that you might know, having had a so bad experience in our previous housing boom, which was also a construction boom and took us to our greatest financial crisis in history, has made everybody, maybe in a discoordinated way, to play a very reluctant or hesitant attitude towards stimulating construction as an activity. No? So I think even town halls that had constructed their financing on the basis of getting income from real estate developments, learned the lesson that this income was volatile and could disappear, and now maybe they are not giving permissions for land development, and at many other levels. It could be also bank supervision, so it could be that even bank supervision carries the memory that real estate development loans were among the most problematic in Spain. They were taking down the whole cajas sector, almost the whole. Let's be careful. This might matter for the big picture. I had a question related to Gaston's presentation on to construct a framework for macroprudential policy in this setup. We might need to agree on what are the goals and the scope. I mean, this is also connected to my impression that the scope might be broadening if we consider social and political supply side constraints. But we need to know about the policy trade-offs and the tools. And we have increasing evidence on the implications of the tools. Do we have good indicators for the precise timing of the activation of the tools and at which intensity? What will be the state of the art regarding this? On Caterina, I think you started with a very optimistic reading of the situation of European households. And you were saying that the situation was improving, and you said something like, the conflicts between monetary policy and macroprudential policy are lower in an environment with higher interest rates. Well, once you have got there and you have survived, I agree. But I guess that the transition from extremely low rates to unexpectedly higher rates was very challenging, and it's true that I'm genuinely surprised by how well things have gone in Europe overall, and definitely in Spain. So, but maybe more broadly, no? Have we learned something that is relevant for the next cycle? Where could be the biggest negative surprises regarding housing risk? Let's say for Western countries, although I think that we should have a more global perspective, no, in the incoming years. So in this world of tariff wars and potential depression associated with the potential evolution of interest rate, what will be your major potential flags to try to detect in housing risk developments in the incoming years? Too many questions. Just feel free to elaborate for 2-3 minutes each on your favorite angle.
I will give you some nuggets, and then I may need to run. But the whole list of questions, I guess that's why I love working in housing markets, because there's so many angles, so many questions and still so little that we know, and we continue to learn, right? But let me maybe touch on what you raised in the general, okay, I talk about supply, and I made a plea, please, let's talk about supply. But how does it fit with the macroprudential policy as it stands? I guess I could make 3 points there. First is understanding the supply, what's happening with supply, can help us understand whether macroprudential tools are the right ones to use, right? And we talked about, I mentioned the twin booms of mortgage credit and housing prices. You added the construction boom into that, right? That's the third pillar, if you would. That's typically a recipe for disaster. And in that context, if, as Caterina said, in the current environment, macroprudential policy is not loose. Credit is not free. It's not like flowing through, and construction is not booming. And if there are calls for macroprudential policies to tighten because house prices are increasing, we need to say, well, no, the source here is the source problem is supply. And that's not macroprudential policy's strength. It's not what macroprudential policy can do. So understanding the source is one point. And there, perhaps one example is Hong Kong. For those of you who might be familiar with that, they are one of the early users of LTV ratios, and they successfully used it for years. And then there was a period where they would continue to tighten LTV ratios, but house prices continued to grow at a robust rate. And then they figured out, well, it's the mainland China buyers coming in and making cash purchases. So you can tighten LTV as much as you want, but house prices will continue to rise, right? The second thing I would say, understanding not only household ones, but the other macroprudential tools we have, how they are affecting property developers, construction companies. There's a supply end there too, building permits and completions. Are we tightening something when we're not intending it to happen? Just understanding, again, the dynamics, not necessarily we need to adjust things. That's kind of like, monetary policy and inequality argument. We need to understand the heterogeneity in the monetary policy transmission. That doesn't mean that monetary policy should try to redistribute, right? And the last point I would say is related to what I said at the beginning. We use it a lot with monetary policy. Monetary policy cannot be the only game in town. Well, with the same token, macroprudential policy cannot be the only game in town. There are other things, and in the supply context, housing supply context, it's the zoning regulations, it is the social housing, anything that you can think, tax incentives, right? Those are in other mandates, other agencies' mandate and objectives that need to come in. Macroprudential cannot do that. And I think it's a danger, actually, for macroprudential policy to try to something, going back to what Gaston said, in terms of having clarity in objectives and mandate. Let me stop there.
Thank you so much, Deniz. And we understand you have to leave. I mean, I think others are not in such a hurry. We started late, so I think we are going to excuse you from being in the panel, and if you agree with that, continue the conversation for a few more minutes. So, Gaston, please. Thank you so much, Deniz.
Thank you, Javier. On your question, as I was highlighting, I think we are not quite there yet in the sense that we can have a calibrated model approach where we can fine-tune and with precision say, if we use this tool, then it will affect the probability of a recession by X or Y%. Ideally we would get a bit closer to that, and then of course it's the judgment, it's the society's policymaker judgment as to when to step in. How risk averse is the policymaker and what are society's preferences in that setting. Now, but we're getting it closer, as I was mentioning. One thing that I did not highlight was that we have also learned that the use of these tools tends to have diminishing returns. So some emerging evidence suggests that if you tighten the screws too much on some of these instruments, then they lose effectiveness, or at least the effectiveness declines. And that has to do probably with leakage, right? And that takes me to the point that most of the tools that are in place currently are bank-based, bank-related, right? So, and in the big picture of macroprudential policy, of course, the growing role of NBFI activities of non-bank financial intermediation is a pending agenda. And more concretely, if you think about the real estate market, often nowadays you have real estate funds that buy either housing or commercial real estate. Sometimes they're very leveraged. They're not necessarily subject, or typically not subject to LTVs. So this is beyond housing and beyond real estate, but also in this area tackling NBFI activities, or having at least an eye on them, and possibly acting if needed, is pending on the agenda. Thank you.
That's a good point. As a European supervisors commonly claim we have data gaps as well as policy understanding gaps and policy tools gaps for the non-bank financial intermediation sector. Caterina?
So maybe I will conclude on stressing the fact that in relation to the build-up of financial stability risks, macroprudential policy is, of course, our first line of defense. But as Deniz said, this doesn't mean that macroprudential policy is the only policy in town. So it is important to acknowledge that while during low rates episodes, low rates environments, macroprudential policy is there to limit the build-up of excessive risk. In a high rates environment, the scope slightly changed and it focused more on supporting resilience and also ensuring that we don't focus too much on the tightening of this policy. As we saw with Luis, it's really important to avoid this unintended excessive tightening of lending standards during periods of high rates. And in general, it seems what our models tell us, Javier, also our joint models, is that it is always very important to consider counterfactuals, because in this counterfactual, what general equilibrium models can tell you is also in which direction the interaction of policies go. So although I agree with Gaston that cannot be the only magic instrument to tell you how to calibrate an instrument, it gives you some important indications on the directions and the interaction of different policies.
Perfect, thank you so much. Let me open the floor for questions. We will accumulate a few. So please, let's have mics into the room. And Carlos is first.
Yeah, so thanks the panelists for all the discussion. Yeah, I found very interesting in particular the reference to supply, and I think that it's an important topic, but also the model that we use. No? So maybe the neoclassical model, even if we move from vertical to upward sloping, is too simple because maybe they are like state variables such as the existing stock or the heterogeneity of suppliers. And I think that crucially and relatedly, whether there is pricing power or there is degree of pricing power, this is hardly ever discussed or considered in terms of housing. It's considered for other markets, breakfast cereals or such, no, but not in housing, and that can affect the evaluation of, for example, the side effects of imposing the borrower-based measure. So yeah, that's a very fascinating question. And also, we are focusing on rightly on cyclical, but maybe also like a structural risk, no? Or, for example, when looking to the real price of housing, in particular in Spain, I think in other jurisdictions too, it has increased over time, like looking from long-term perspective from the 80s. And this has certainly conditioned the sectoral composition of the economy. So just that reflection, or what are your thoughts on potential structural risk, like the increase in house prices can stabilize, but if they are like high relative to other goods in the economy, that can impose some structural risks. Thank you.
Any other raised hand? David.
My question is, so I really enjoyed the session. My question is for Gaston. What are your views on the institutional setting of the macroprudential institution, particularly in a monetary union where you might have geographically different natural rates of interest rates? Should it be the central bank? Should it be a centralized institution? Should it be national? What are your thoughts on that in terms of beyond, it has to be independent? Thank you.
We also have Federico.
Yeah, very interesting panel. Thanks. Oh, this is very loud. So my question is for Gaston as well. I was wondering simply about whether there is some clear cross-country heterogeneity in these growth at risk measures following the implementation of macroprudential policies, and also whether how we should evaluate the benefits versus the costs. So the cost would be in terms of less growth, so the other tail basically. Is there any chance of using those tools also to evaluate that? Yeah, thanks.
Okay, I think we can go from here also because we are already eating on our lunch break. So who wants to take questions first?
You have more to say.
Thank you. I mean, on the institutional setup, there is no best solution, right? And in principle, you find following different models, right? You have either the model where you have a central bank that has the main powers, or you have a supervisor separate from the central bank that has the main powers in this area, or you have an interagency macroprudential authority with powers or without powers. It could be just a kind of a consultative one, in which case often the macroprudential powers are split between different authorities. And again, I don't think there is one model that it's best, but there is some evidence that that along the lines that I was saying, that it helps particularly in communication. If you communicate and then you can also follow up with action, for example, right? That makes it much more powerful. There's also evidence, I mean, there's not much literature in this area, but there is some evidence that central banks that also are in a such an interagency financial stability council that they can communicate better the macroprudential action. So there is some emerging evidence on the role of central banks and financial stability committees that supports some of these notions, but it's an area that's still being researched. The other question was on cross-country differences, right, and on the cost benefits. So we didn't see. I mean, we looked a little bit at differences across emerging markets, advanced economies. It becomes a little tricky because then you have the sample size becomes smaller, and you need a lot of data for these exercises. And so that became a bit difficult to do. But regarding the question of cost and benefits, well, in principle, I mean, you can construct your own loss function according to your preferences. I was talking about a standard quadratic loss function where you put a weight on the variance of output and another weight on the variance on inflation, but you could think of other metrics. And then you can compare what is this metric, what does this metric give you if you don't do anything, and then you can compare them with taking specific actions. So in that sense, it's empirical and it has its limitation, but it can also serve a bit as a counterfactual exercise. Thank you.
Thank you.
Just maybe very quickly on the cost. It's like there is lots of analysis on the direct cost and benefits of the implementation of macroprudential policy, and there is a bit more limited but growing evidence also on potential aggregate cost. which one thing on which I think is still we need to accumulate more knowledge is how this aggregate potential cost affects the distributive effects of this macroprudential policy. Because also going back to the counterfactual analysis, you always see that when there are aggregate costs, also other policies might react. And so understanding in which direction this goes in terms of mitigating the cost for a part of the population or enhancing the benefits for some other, I think is still something we should learn about.
May I just on this point? Yes. I agree, and I think I think the evidence so far suggests quite consistently that the side effects, the unintended costs of macroprudential measures are fairly limited. So that's good news. So this is what the emerging evidence tends to find. Thanks.
And there is possibly, if I can add, room for fiscal policy to offset some of the redistributional implications at some point. No, I think we should not mix up the need to keep the financial system stable with the need to promote access to housing. In a sense, that conflict could be solved by the fiscal authorities with the right measures. I think Carlos was referring to a very interesting issue on market power. I'm not sure we really know about it. But just one thought that your remark was provoking to me was about who is the monopolist in this context. In some cases, it's the local authorities with their capacity to expand the line beyond or within construction can take place. So I wonder whether we have excessive exercise of monopoly power on the use of land by the corresponding authorities, and that it will be connected to who should be the authority. Whether the local power, which is potentially influenced by the local owners of land, or there should be a more centralized policy as for which lands can be subject to construction or not. I just leave it there. And before we end, I would like to thank our panelists today, including Deniz that left earlier, but also the organizers of this very nice conference, Banco de España for hosting and organizing, Rafa Repullo as usual with all the impulse, Galo Nuño and others who were in the background of this very nice conference. As a participant, I have enjoyed it a lot. As a member of CEMFI's faculty, let me also thank everybody else for attending this, I guess, successful event. So big applause to all of you.